Welcome to Taking Stock. I'm Amanda Lang. Coming up, a special look at Canada's economy. As businesses face massive uncertainty, where will they find confidence? And exports matter, but so does our domestic growth story. Plus, doing what we do more efficiently could be the fastest way to juice the economy. That is all ahead. First, here's a look at the makeup of Canada's economy by the numbers. By the end of 2024, Canada's gross domestic product stood at $2.2 trillion U.S. and is expected to grow slightly when the 2025 tally is in. On a per capita basis, that's $54,283 U.S. dollars per person. And at the end of 2024, we ranked as the 10th largest economy in the world. The largest sector of Canada's economy in terms of contribution to GDP is real estate at more than $300 billion, followed by manufacturing at $200 billion. And then healthcare, finance, and public administration. Manufacturers are important for trade, too, representing 68% of our merchandise exports, valued at $354 billion a year. Exports are important to Canada. They represent about 30% of our economy, but that leaves 70% that is domestic-facing. And the services sectors are by far the largest employers in the country. Of the 18 million jobs in Canada, 14.7 million are in service-producing businesses. Services are a key component of exports, too, but 70% of the sector's activity is domestic. Meanwhile, some estimates suggest up to 11% of Canada's economic activity happens outside of recorded sectors. With the Canadian economy facing unprecedented challenges, we need businesses to feel confident enough to grow, and that means confident enough to invest. So where are the places of opportunity likely to lie? Andrew DeCapo is principal economist at the Canadian Chamber of Commerce. Andrew, thanks for being with us.
Yeah, thanks, Amanda. Great to be here.
And, I want to start with something that I feel gets overlooked in the conversation about the Canadian economy lately. Because we're so focused on that U.S. relationship and the importance of trade and our exports, it's how big and strong our domestic economy is and what that represents as a source of opportunity and growth. Do you think we could do better at actually paying attention to and fostering that side of the equation?
Well, that's exactly right. I mean, I think if there's one thing that I'm concerned about as we head into a new year, is that there's a lot of noise that is going on, right? We have threats to central bank independence. We've got geopolitical risks that are coming back to the forefront. We have, the Prime Minister heading externally to different countries to try to improve, our relations with other countries, as well as opening up new opportunities. And so there's a lot going on, and we got to remember that we have to get back to the root issues, which is the domestic economy, right? It is investing more here so that we can produce more, that we can pay better wages, and that we can grow the domestic economy. And so that is definitely something that we have to stay focused on, because, one of the things that I think we're all tired of is sort of this survival mode, right? We need to start thriving, move from surviving to thriving. Yep. And that requires investment, that requires, focus. And so that's something that we're going to be, paying attention to, because we've been doing an awful lot of talking. And this is the year where expectations are quite high, as you mentioned, and is going to definitely involve the business community in making that happen.
One of the stories recently that I feel like is sort of a sleeper story of great importance was McDonald's Canada lowering its prices. It's a small thing it did. It's a big company. Obviously, it can take a hit to margins here or there. But to me, it speaks to its concern about its consumers. It is a value play, and it's worried people will only pay $1 for their small coffee, or they won't buy that coffee. I'm worried about what that says about the state of business confidence in this country. What are you hearing from your member base? Are they feeling okay about the consumer and that domestic economy holding up in the year ahead?
Yeah. Well, affordability is still around, right? It is still top of mind for Canadian households, and the business community, of course, is definitely hearing that. I mean, if you look at, in terms of your question around how businesses are feeling, in our latest Q4 Business Insights survey, consumer confidence is still subdued. And when you look at consumer confidence, it is also subdued. I think something interesting that we're seeing, at least in the economic data, is that we're seeing this decoupling of consumer confidence and consumer spending and consumer demand, right? Based on our sales tracker data, sales are still up about 4% on a year-over-year basis. And even when you adjust for, population, which is declining, it's still growing on a per person basis. So of course, affordability is still top of mind. It's just decoupling a little bit from the economic data, which makes getting to the issue a little bit more concerning. Affordability is still going to be an issue this year, but the one silver lining in this is that CPI seems to be growing on target. Price stability is still there in general,
Yeah.
And definitely affordability measures are or affordability rather is going to need to be addressed, but it's not a silver bullet.
One of the things that might help, of course, domestic economy and our companies here is the Buy Canadian push. Is it too soon to quantify the kind of difference that support might make?
So whether it's on goods or services, it seems like Canadians have really started to buy Canadian goods over American goods. Even snowplow manufacturers are buying Canadian steel. Ice cream makers are using fruits and nuts from Canada. So there has been a shift in that, but what I would say is, about 50% of businesses, based on our most recent survey, are indicating that they're not actually taking any action as a result of the trade war. And, to me, that is, a concerning stat as it pertains to sort of getting out of this mess and sort of taking the action necessary now to diversify markets, to improve our domestic, capabilities, to be able to sell more to other markets.
So good to have you, Andrew. Appreciate your time today.
Thanks, Amanda.
Andrew DeCapua is principal economist at the Canadian Chamber of Commerce. Still ahead, from our manufacturing base to diversifying trade, the challenges that lie ahead. Welcome back. As Canada works to pivot our economy and trade, we are also thinking about new ways about manufacturing more at home. So where are the opportunities and what might we stop doing? Dennis Darby is president and CEO of the Canadian Manufacturers and Exporters Association. Dennis, thanks for being with us.
No problem. Thanks to be here.
So we are in almost a golden era of manufacturing where people are thinking in a new way about doing more here. We aren't necessarily going to offshore everything. Building things here, making things here is back in vogue. What is the opportunity to build the manufacturing base in Canada?
Well, first of all, we should try to level set. We're still selling, the majority of the manufactured goods we produce in Canada to the U.S. Regardless of reports about lessening dependency, still about 80% of what we produced even last year went to the U.S. So we are integrated in the supply chain. So we shouldn't expect for a minute that won't continue. What is different, though, is, as you mentioned, is the opportunity to build at home. And of course, the federal government, since it was elected, has talked about things like Buy Canada or Buy Canadian. The Ontario government has talked about, Buy Ontario. So those initiatives, which would help, offset some of the losses of exports to the U.S., which are down about $2.5 billion by the end of 2025, would really help. And that would mean things like defense, in the areas of construction of new housing, building new infrastructure. These are areas that are positive, really positive looking. But right now, we're waiting to see where things land, because at this point, lots of discussion, but not a lot of meat on the bones yet.
Yeah, fair enough. But are the discussions sensible? In other words, when we talk to, Sweden about a new fighter jet, should we say it has to be built here? If we're going to have Chinese electric vehicles, they have to be built in Canada. Can we create a manufacturing base with new partners beyond the U.S.?
Well, most certainly. I mean, even in the case of existing fighter jets, the F-35s, a lot of the work will be done in Canada. So there is a percentage of the manufacturing that had been committed by the manufacturer in Canada. It would be the same if we were to work with Sweden. And yes, we have an incredibly strong manufacturing base in the area of automobile parts and automobile assembly. We should really look at those. So yes, indeed, those are, and not just maybe to China, but also to Europe, how to get other companies to assemble here. We have a great workforce. We have great technology that we've developed over the years. And of course, ultimately, as we switch more and more to electric vehicles, or at least vehicles that use electric power like hybrids, we have the potential of the minerals and the construction of those of the components. So yes, there's lots of upside, not to mention the area of energy production, because everything from nuclear power to advanced technologies to help carbon capture, those are all technologies where Canada can be a manufacturing center.
Manufacturing, of course, will be less and less about a lot of employees. The human aspect of it will decline over time because of new technology. That's very good for corporations. It's very good for consumers. Not so good for manufacturing jobs. How far in the future are we looking at that sort of advanced robotics era? And do you worry about that for our sectors?
Well, actually, I worry if we didn't look at that. In fact, what we've seen, one of the encouraging signs, despite the fact we continue to hear from manufacturers that they're putting a pause on investment because of the uncertainty with the U.S., given that manufacturers are really caught in the crossfire of the tariffs. But we're hearing already that small and medium-sized companies are more and more looking at what we call Industry 4.0 or machine learning, because actually, despite everything, there continues to be a shortage of workers with the kinds of skills that manufacturers need, despite the current situation. So what that means is, if we can start to use more and more of these high-tech tools, machine learning, AI, what we call Industry 4.0, that's good for Canadian jobs, because the types of jobs that are there will be more highly more technical and require more skills, but it also gives us a chance to increase our output. So right now, despite everything going on, manufacturers in many sectors are still looking for people.
Dennis, so good to have you. Appreciate your time today.
Thanks.
Dennis Darby, President and CEO of the Canadian Manufacturers and Exporters Association. Diversifying Canadian exports is central to our economic future. So what kind of progress can we make, and how quickly? Stuart Bergman is Chief Economist at EDC. Stuart, thanks for being with us.
Hi, Amanda. It's my pleasure to be here.
Well, that is sure the task at hand. So let's start with how quickly we can do that. The goal is ambitious, but how hard is it for the Canadian economy to pivot away from the U.S.?
Well, look, I'll give you a bit of an economist answer here. So, you may not get the answer you're looking for, but it really depends, right? It really depends on the industry you're in. I mean, some industries tend to be far more integrated into the North American supply chain. You take autos as an example. Or rely on specialized infrastructure to move their product. And so, pipelines needed to ship oil and gas are a good example of that. And there are, of course, other logistical considerations like the cost of bulk shipping. Whereas industries like crops or pharmaceuticals, or even if you think about some other consumer goods, those might be easier to ship overseas. And then, of course, you have exports of services. And I would add maybe digitally enabled services in particular that open enormous opportunities for trade diversification. And it's why, as I referenced earlier, only 50% of our services exports actually go to the United States. So I'll also say that it depends on the exporter, because whereas typically the bigger companies, the larger companies, tend to have the financial wherewithal to strategize around new markets and absorb the logistical costs that come with changing buyers. So you think about, the cost of risk management, developing local contacts, or managing new regulatory realities, business cultures. The smaller ones don't. And then, of course, finally, it really depends on the contract terms that companies may be locked into. So it really very much depends on, where you find yourself as to how easy it might be to pivot, not away from the United States, but to do more business in addition to the business you're doing in the United States. Because
we have to do it quickly, if we're planning policies that help us get there, it sounds to me as though you pick the ones that are easy to trade to Europe, to send raw materials, whether it's to China or India. In other words, if you were betting on which industries will succeed over the next decade, if our trade relationship with the U.S. deteriorates, you should look at the things that are easiest to diversify?
Yeah, I mean, that certainly makes sense. There's low-lying fruit. I will definitely go back to exports of services being the low-lying fruit, not dependent on the infrastructure that we know, where we know, we still have some some room to build. The links tend to be a lot more seamless, and so digitally enabled services in particular. Of course, we have long-standing ties in energy with the Asia Pacific region already. We have now enhanced our infrastructure when it comes to energy trade in Asia Pacific, including the expansion, the TMX, and adding capacity on West Coast ports, LNG export terminals. So that certainly helps as well. So those might be kind of a bit of a low-lying fruit. And then, we start to have to look at some of the industries that might take a little bit more time and might be harder to diversify.
Thank you so much for this, Stuart. Really appreciate your time today.
It's my pleasure. Happy to be here.
Stuart Bergman is Chief Economist at EDC. Coming up, Canada needs to improve its wealth creation. To do that, we need to get more efficient. Stay with us. Welcome back. Growing Canada's economy is a worthy goal, but unless we fix how efficiently our economy operates, we risk leaving real wealth on the table. So how can Canada tackle its productivity problem? Charles Santano is Chief Economist at Service Credit Union. Charles, thanks for being with us.
Thank you for having me.
So the productivity problem, of course, we know leaves wealth, that erodes our wealth over time. It's been such a long-standing problem that I actually want to start a bit big picture and say, what do you think we should do that we haven't tried to improve how efficiently our economy operates?
Well, I think finally we're actually talking about it and being more willing to put action in place. So that's actually giving me a bit more confidence. But as you said, it has been a long-standing issue. Productivity in Canada has been weak for decades, and it's really an issue where we're not investing sufficiently in productive means, whether it is machinery, equipment, into intellectual property, research and development. So it's really, how do we spur more spending in those areas?
One of the things we've seen is that when business feels the uncertainty in the world, we saw this in the first Trump administration. I can only imagine it's going to be worse this time, Charles. They don't spend. Confidence, of course, erodes. The role of government, I guess, is to try to instill confidence. The recent budget was aimed at attracting up to $1 trillion in private capital. Are the pieces in place to help business feel more confident?
Well, we're putting in place, or I would say it's a step in the right direction. Does it solve all the problem? Unlikely, but at least I feel confidence with the recent budget and the recent announcement by the government is that there's becoming a bit more of a realization in Canada that we need to take more care and help grow the supply side of the economy and stop focusing solely on the demand side and supporting consumers. And that's what we really need at the moment to actually spur our productivity going forward.
We have seen successive governments for decades try policies aimed at spurring this kind of investment, right? The shred tax credits aimed at kind of encouraging investment. Is there more of a cultural issue here, Charles? And if so, is there a different way to go about this to actually try to change the way Canadians think about taking risk and investing in ourselves?
Yeah, I think it's true. We need to have a cultural change. One of the things that was important, and we see it in the data, is and as I said earlier, is that we kind of always put too much emphasis on demand. How do we spur and support consumer demand, whether it's on housing and everything, without looking at the supply side? There's also issues where we're not necessarily thinking hard enough in terms of how are companies funding those investments, because it's nice to be willing to invest, but if we cannot get the capital at a decent price, then companies are not going to invest. And there's been evidence over the past 20 plus years that actually households who are also borrowing for consumption and to buy ever so expensive homes have actually crowded out the investment in the business sector. So we also need to think about that, is how can we actually divert more of our capital, more of our savings towards investment?
I mean, the good news there, Charles, is perhaps if we could make housing less of a kind of behemoth in terms of where the place it occupies in our overall economy, largest sector of the GDP, it might also have the effect of ending that crowding out, right? More banking credit available to businesses.
Yeah, but it's also a rotation in terms of we'll need to find a way of how to finance that investment, because at the end of the day, in economics, the sum of your investment in your economy is also the sum of your savings, whether it's domestic or foreign. So we'll need to make sure that we have access to that pool of capital to finance all our goals in terms of investment, whether it is productivity enhancing through machinery and equipment, whether it's military spending, whether it is affordability. We'll need a lot of investment in residential housing also to solve affordability. So we have a lot of needs, and it's not clear we have thought in terms of how are we going to finance all those investment needs.
Charles, so good to have you. Appreciate your time today.
Thank you for having me.
Charles St-Onneau is chief economist at Service Credit Union. Time for the takeaway, and when stuff gets real. In many ways, Canada is a country of advantages. Rich in natural resources, including abundant fresh water and 3 coastlines, Canada also made the most of its close proximity to the diverse and vibrant economy to the south. Call it the best of both worlds. Our small population could enjoy access to major markets while constructing a society along the lines we chose, based on shared wealth. Our healthcare system created a leveling effect, and while it's far from perfect, it remains the envy of most countries. Our spectacular natural endowments mean Canadians can live in cities that are often minutes away from nature's splendor. And we use our wealth to create a solid system of education. Built by our immigrant forebears, Canada is tolerant to newcomers and understands the value of diversity. Did we let our proximity to America make us a little lazy? Did we get a bit smug about our healthcare and education? Probably yes on all fronts. And now, with the mother of all wake-up calls, we've realized that our assumptions about the world have to change. We may still trade with the big economy to the south. Much of the business we do is province to state, and those are good customers. But we will find new ones as well. And while we do it, remind ourselves to be competitive, innovative, and operate as leanly as possible. While the world gets a little less integrated, we'll become a little more independent, making sure we can be self-sufficient in things that matter, so we aren't reliant on the kindness of other nations. That independence should be good for our economy, as it favors homegrown solutions. None of this is to say Canada should take anything for granted. Our debt levels, both for governments and households, need to be recalibrated, and our willingness to dig deep will be tested as we work to capture new markets and customers. But if we have challenges ahead of us, we also have everything we need to meet those challenges. My takeaway, Canada's economic future could go different directions, but it should feel good that the outcome is in our hands. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.